Hello and welcome to Econoday Unplugged on Tuesday, the 31st of March 2020. Mark Pender is on the US East Coast and I'm Jeremy Hawkins here in London. Well, amidst all the market volatility, there have been at least a few signs in recent days that investors are beginning to give the policymakers the benefit of the doubt. And that's even if the fiscal response from some regions, notably Europe, still lacks the coordination needed to give it full value for money. There's certainly been some bottom fishing going on in the equity markets. The Dow last Tuesday through Thursday saw its biggest three-session winning streak since 1931. And the dollar's just ended its worst week since 1985. And that's a good thing because it means global liquidity strains are not what they were earlier in the month. Of course, there's still a long way to go to recover all the previous losses, and it could yet be that the upcoming economic news is so poor that even current asset price levels can't be sustained. Time will tell, but we are starting to get a few bits and pieces of data through that give us some tentative indication of what's been going on for this month. So, Mark, where's the US stand? And while we're at it, I see the Fed's been busy yet again.
Yes, establishing a repo facility for central banks. This is part of their dollar swap arrangements with central banks that they've been announcing and extending over the last several weeks. And this is what you were saying, which is to reduce the liquidity strain for U.S. investments. As far as the data goes, well, it is, I guess, surprisingly disastrous. It's kind of inexplicable, really. We had at least today's conference board report from for consumer confidence. The cutoff date of this was March 19th. And if you recall, the jobless claims report for March 21, for the week ended March 21, and that was a Saturday, was 3.3 million unemployment. And and actually the Econoday forecast is looking at about that right now for the next week as well. But looking back again at March, it didn't seem to affect this panel at all. And this is a very large panel of consumers. This is a phone survey of thousands, several thousand consumers. So it's a very substantial.
Can I ask you a quick question on that? I don't know if you have this or not, but do they give you sort of the regional breakdowns? So the kind of, the coronavirus hub, stateside, New York, and that sort of thing.
That's an interesting question. Let me just see here. Hang on a second.
And I don't know how far disaggregated this data is. On Europe, we get this EU sentiment thing, which we talked about, where they actually break it down into individual countries.
Well, as I'm looking that up, I can say, however, that the overall national readings were very little changed. Still a very favorable. A still very favorable assessment of the current jobs market, which is kind of a shock, almost like in line with the pre-virus economy. Very few people saying jobs are hard to get, and a lot of people saying jobs are plentiful. Let me just look here for the regional breakdown. I didn't want. They have, of course, income breakdowns, and they do have a regional breakdown. Let's see here. We can just look at this real quickly. I guess the mountain states and Pacific states are going to be the most affected because of Washington and California, of course. Also, the East and New England. I'm just looking at these numbers right away. Mid-Atlantic, East, North, Central. Really nothing that is striking or lopsided. They're using a census breakdown here, and I can see by regional, but nothing that hits you over the head as being a regional issue. It's like I say, I guess it's an inexplicable report, but and what this is going to do is it's going to limit the expectations, which are already very limited, for deterioration in Friday's employment report, U.S. employment report, where the Econoday consensus is for a very limited decline of 150,000 in payroll. Mm-hmm. Now, the low estimates here are in the millions, a couple of million. So there are economists who are seeing it, who are expecting a catastrophic change in payrolls. So it'll be a very interesting question. In the U.S., not everyone is on payrolls, especially in the service or the accommodation and food services industries. So maybe they won't show up, but then they would definitely show up then in the household half of the employment report, the non-payroll part of the employment report. So something would have to crack, and there are some expectations for a jump in the unemployment rate. But so far, it's a little bit of a mystery, why this employment catastrophic or unprecedented climb in initial jobless claims, which is absolutely has been established, isn't reflected yet in consumer sentiment. So I guess it's just a question of time. They didn't put a warning in the report whether low sample sizes were responsible for this, but this is a telephone survey, so you wouldn't think that would be an issue. But let me head it back over to your court. We had German unemployment today, and I see that was sampled early in the month of March, but no effect at all, still 5% where it's been for a long time. Is the German economy, especially comparison to the American economy, the American idea or the traditional, don't want to use the word socialism exactly like this, but there is a greater assumption of a social safety net in Germany. Do you think that will affect how the unemployment arises there?
Possibly. I think one of the issues for the German economy is that because of the labour market has been so tight for so long, even though expectations for future business, future output and so on are extremely low, and in a number of countries right across Europe, they're close to record lows, if not actually at all-time lows. But still this sense, I think, particularly within Germany, that they want to retain skilled labour. And what they're concerned about is that, let's be honest, no one really has a clear idea about how the coronavirus is going to pan out, be it a V-shaped recovery or a U-shaped recovery. But if it's going to be a V-shaped one, it's possible that a number of these firms in Germany will want to hang on to skilled labour, because there's been a shortage of skilled labourers out there now for the last couple of years or so, really, which means it's perhaps helping to at least artificially hold down the unemployment rate, at least for the time being. But I think chances are we will start to see these jobless figures going up during the course of the next few months. In terms of looking at how Germany stacks up against the likes from your side, we had this GfK consumer confidence indicator, which markets placed quite a lot of attention upon, really, and that saw a hefty decline. Sort of their expectations for April, so one of the sharpest declines on record. Now that's actually borne out in the real data. It would suggest we could see quite a sharp slowdown in terms of overall consumer spending, and that's never going to weigh on Germany and indeed the rest of the Eurozone. But it's interesting looking at some of the recent data we've had here. You mentioned from your side there hasn't been too much coming out of the stats guys, to the extent that perhaps the data themselves may not be quite as reliable as normal. Well, we've certainly had indications from Eurostat, the guys who are responsible for the bulk of the Eurozone economic figures, suggesting that although most of the March numbers should be treated as being pretty well reliable, they are now starting to get some problems, some issues with both regional coverage, individual countries supplying the data, and also problems with product coverage as well. So in the flash inflation figures we had out this morning, there was a footnote at the bottom of that report, just dropping a few hints. Well, look, we think these numbers are reliable, but it's starting to get harder to get the data compiled. So just read that, reading between the lines, it does suggest there are going to be some issues regarding the accuracy of, well, let's be honest, most countries' data, I suspect, over the course of the next few months. Otherwise, well, it's interesting. What can we sort of draw from the numbers we do have out of Europe so far? And again, the ones which are useful, I suppose, are really still. UK was interesting with a news sort of survey, a private survey which came out earlier on this morning, and that really highlighted the panic buying of essentials and particularly groceries. So looking at the last 4 weeks, year-on-year supermarket sales basically of groceries and food and so forth, they're up by almost 21% on a year-on-year basis. And that's a reflection of the fact they estimate about 88% of households visited food stores during the previous week, adding about 42 million extra trips across 4 days. So this is very much an indication, the panic buying surrounded by this coronavirus that a lot of people have been talking about. And it's kind of apparent, I think, in some of the inflation figures from the Eurozone. Now, headline inflation itself was soft. Indeed, we saw it quite a lot weaker than expected. We're now down on a headline basis for Eurozone inflation to just 0.7%. That's down 0.5 percentage points from February. And that's one of the biggest drops we've ever seen. But looking at the breakdown, core inflation, so we strip out energy, which we know fell out of bed in March, and food, that also came down a couple of ticks as well, down to 1% from 1.2%. But the food component of that was actually up quite significantly. So it does fit in with this general idea that the first round impacts on inflation, at least as far as the Eurozone is concerned, is this panic buying of essentials like food putting upward pressure on food prices, but non-essential items simply coming under increasing downside pressure due to the lack of demand. I wonder if you've got any of that kind of balance showing through from your statistics.
Well, let's turn back to the consumer confidence report. They really buying plans for significant goods like major appliances and cars, also houses. They did come down, but nothing too dramatic. By the way, now you were citing UK shopping data?
Yeah.
Is that a weekly report, or is that?
This is just a private sector report which came out this morning. I think, to be honest, it's a one-off, so it's not a regular one.
Okay, well, we have the regular one here in the U.S. We had Redbook, and it's been Redbook is general merchandise and clothing, those categories, excluding autos, gasoline, restaurants, and they have been spiking. Now, the spike has been coming down a little bit, but definitely was showing the stockpiling going on. And we'll have the CPI next week for March for the U.S., and it wouldn't be or was that coming out? That's coming out a week from Friday. And you would expect to see some kind of price traction for general merchandise. But at the same time, oil prices are going down. Also, demand for gasoline is going down with these restrictions, of course, and the price of gasoline is actually coming down. And so that's going to be a very significant thing. We're also going to get motor vehicle sales coming in on the 1st and the 2nd in the next couple of days. And the expectations there are looking pretty grim. So, and it's not, and actually where I am in Pennsylvania, it's actually illegal to sell a car right now. So for new dealers. So,
all right.
So that's going to be, and that's, 20% of the retail sales are going to buying used and new vehicles. So, that would be a significant downdraft. But I guess, for the U.S., it's going to be the employment report, I guess, on Friday, even though it was sampled in the first half of the month, or actually the second week of the month in March. So it's not going to pick up the entire disaster that apparently that certainly has happened with those unemployment claims. But like I say, the consumer doesn't seem to be overly affected right now, judging by the consumer confidence report.
Well, I think one of the things to look at over here is going to be the PMIs. Now, these are just the final surveys for manufacturing we'll get for Europe tomorrow, Wednesday, and then the composite output index, the overall combined surveys, that's due out the final figures there on Friday. Now, typically speaking, certainly as far as Europe's concerned anyway, you tend to get very small revisions between the flash data and the revised final data. This time round, I do wonder whether there's scope to actually see something a bit different. And I say that because looking at most of the figures and the survey data we've had out so far, it's by and large been taken before around about the 16th of March. And that was when we started to see a whole swathe of national lockdowns being introduced right across Europe. So it could well be that, the second half of March economic activity in general then might well be significantly lower than it was over the first half of March. So I think it's worthwhile keeping an eye on the flash PMIs, which, to be honest, people tend to look at just briefly because normally are not revised very much. There is perhaps that much more scope for some kind of revision this time.
Mm-hmm.
The other thing sorry.
Go ahead.
I'll just mention in terms of just the numbers, the other big thing I should mention in case anyone hasn't noticed it is that as a result of this coronavirus and due to some of the impact it's had on the workforce, the UK Office of National Statistics now decided to bring forward the release time for most of the major UK economic numbers. So local time in the UK, it's always been 9:30 in the morning. Mm-hmm. They're now going to come out at 7 o'clock in the morning. It's not for all numbers. The private indicators like the purchasing managers surveys, CBR, money supply and so on won't be affected, but it will be a new release time for most of the major UK numbers.
And I'd like to assure our listeners that we are very alert to to time changes on this data. So when you're looking at the economy calendar, it's going to be updated with the proper time as soon as we get the information. But let me just turn off to a big report that came on this morning Chinese time, and that's the official manufacturing PMI, the CFLP. That popped up. Now that's not a surprise, because these diffusion indexes measure month to month. The questions are month to month. So, are your new orders up from last month? Are they down from last month? And then you get a general reading. So because we'd been talking about this before, because the comparison was so incredibly easy in the depressed virus months of January and February, that any kind of improvement would come up to a strong reading. Actually, I think it came in at 52. That's not a really great reading, because a 50 reading would mean that there was no change from the January, February, or did they release the CFLP in a combined month for January and February? Let me just check.
This one was just for March.
This was for March, and they released it for January and February as well. Okay, so the comparison then is February. So actually, and it was 52.0, and February was 35.7. Now that is a really significant decline in composite activity from January. A 52 is just shows a little bit improvement from February. So it's still a very weak reading. It's because of the base, but that's a little nuance in how to appreciate these diffusion indexes. So we have to be careful in describing that strength, because the absolute strength is very little changed from February.
Yeah, and I can just add to that. I think you're exactly right in terms you've got to be careful how you interpret these things, because their diffusion index is effective. They're qualitative rather than quantitative. Mm-hmm. And what I mean there is, let's suppose we've got the start of a turnaround from a really deep recession. You could well get almost every company, let's say, increasing its supply of widgets by one widget out of a typical baseline of 100. Well, if everyone just managed to produce one more widget, you'll get a 100 reading on the PMI. If they all produce 10 widgets more, you still only get a 100 reading. So it's, as you say, you've got to be very careful how you interpret this stuff during times when you've got big swings going on in actual output.
Right. Reader beware. Usually a 52 reading is a solid incremental increase from a normal level. But that's not how this 52 is. This 52 is from a very, very, very low level.
Yeah. So, another thing on those lines as well, I think also when we're talking about some of the forecasts coming out, I mean, you were talking about the expectations for the payroll and so on Friday. I think when we're at the start of what appears to be perhaps a steep downturn, perhaps we'll get away and it won't be too bad. But the bottom line is that forecasters don't really have that much of a clue at the moment, because this is completely unprecedented as far as
it's kind of unfair to them, and they were kind of under a lot of stress to come up with some kind of a number. And we saw that with Goldman Sachs or Morgan Stanley just plucking numbers out of the air where they think GDP is going to fall. They say it with some authority, but it's a complete blind guess.
It is. Yeah, exactly that. Okay. Quickly, before we round off, before we prattle on for too long, I should just mention one change to ECB policy. Obviously, all sorts of, well, governments and central banks are throwing the proverbial kitchen sink at these economies and markets at the moment to try and stabilise things. Well, the ECB last Thursday, which I don't think was too well documented, gave itself sort of what they called extraordinary new powers, which effectively means it can buy up almost unlimited amounts of sovereign debt. Now, the way they operate in the past, they have this so-called capital key. And it's really that effectively determines how many bonds the ECB can buy from individual Eurozone member states. And effectively, they can't buy more than a third of the entire supply of bonds. Well, that still applies to their existing so-called QE program. But their new this pandemic emergency purchase program they introduced, a week or so ago, under that, there are no rules applied to it, which essentially means they can now go out and buy whatever they want. So although they may not be saying it as much, essentially we're now talking about, a la US, unlimited quantitative easing from the ECB if they want to go down that route.
And there's no regulation authorities, no complaints.
Well, this is
traditionalists.
There's going to be some, no doubt. I say they've got the scope to do it now. Whether or not the likes of Germany and the Netherlands will allow them to do it, of course, is very much another issue. But at least they have the scope to do it now, where they didn't before. Indeed, I should also mention, I think we talked about it briefly last week, but the EU Commission Council officially requested the abandonment of the Growth and Stability Pact last week as well. Yeah. So that will be going through, which allows budget deficits to go up.
At the risk of prattling on too long, can you touch really quickly on what is going on right now within the EU, the coronavirus bonds, and I guess some kind of strains with Italy and Spain?
Yeah, one of the problems I think at the moment is that ideally, there's this view that they should be issuing some kind of coronavirus bond, which effectively would be sort of a euro bond, which would allow additional funding for all the various national governments with regards to trying to tackle the coronavirus. The problem is that we have countries, notably Germany and the Netherlands, who have been opposing this call from the hardest hit countries, and they're really Italy, Spain, and France at the moment, to issue this euro bond. And it really comes down to the fact that the likes of Germany doesn't want to see its borrowing being attached to something with an Italian bond on it, which effectively would it come out as being, because it would be this kind of whole eurozone wide bond. And it's one of these chinks in the armor, which raises a question that can, at the end of the day, that at the EU level, can we get a response which will provide EU citizens with what they want, show them the solidarity which you want to have right across the European Union, or is it still going to be this fractional, uncoordinated approach that we've seen in the past? And it is one of the big issues, I think, which is investors more longer term are going to have to consider for the eurozone, because when you get push comes to shove, you don't always get the kind of harmonious and unity showing that you really need over aspects of policy that investors really want to see. With regards to Italy, well, the news just continues to be bad out there. I mean, I suppose the good news is that there are some indications that the death rate is flattening out and maybe coming down a little bit now. But there's still major concerns about the rate of growth and the spread of the virus. We've had social unrest taking place increasingly in the south of the country now. There's a danger of making it into this kind of north-south divide, which can't be good news. So Italy at the moment is still very much one of the very much the hot spot as far as the coronavirus is within Europe. But it is interesting because what's happening now right across Europe is going to be a test of political harmony for the eurozone. And how it emerges from this could well determine at the end of the day whether investors will trust the euro or not. Okay, what else have we got? Are we done for now? I think we're probably done. Yeah, I think we're done. Okay, let's call it a day then as far as this week's concerned. Well, I guess the outlook for financial markets inevitably remains highly certain. But once investors are convinced that the current shakeout has ended, they'll be on the lookout to see which economies are staging the strongest recoveries. So the economic data will be more important than ever. So keep up to date with all the major numbers and events in Econoday's global economic calendar. Thanks as always for listening. And on a personal note, and in the interest of a less stressful lockdown at home, it's the wife's birthday. So if you're listening, happy birthday, Sheila. Right. Mark and I will be back next week, and joining us will be our Asian expert, Brian Jackson. We'll see you then. Bye for now.